Hey everyone, Paul Clark here with Taking Stock Investing, and I had a request from a subscriber to walk through Fubo TV. So that's what I'm going to be walking through today. And if anyone watching this, if you have a request for a stock that you would like to see me walk through, just go ahead and let me know in the comments below and I will put that video together for you. And of course, as always, if you get any value out of this or if you enjoy this video, please subscribe to the channel. It'll help me out greatly, and I'm planning to continue to put out more information about stocks and investing, and I think that you guys will appreciate that if you like this video, so thanks for that. With that being said, let's go ahead and get into it. One of the cool things about Fubo TV is that they actually operate as a sports first platform, so they're really going to be for somebody who doesn't have cable but still wants to watch the game. You want to watch your NBA, soccer, football, any of those things, like they can help you do that. But then they've got other channels as well, but they really kind of brand themselves as sports first. Now, what I think is nice about that business model is that, with the adoption and the legalization of online sports wagering in the United States, I think that's going to drive a lot of future interest in watching sports. And in fact, I think that's actually why a lot of the leagues have been so open to allowing or endorsing sports wagering, because I think that they understand that that's going to drive much more engagement with watching these games. And of course, by watching these games, that's going to help Fubo even more for people who are going to be, again, cutting cable but still wanting to watch sports. But they actually were established 5 years ago, back in 2015, but they just went public just a month ago. So they went public in October of 2020 here, and they just had their first earnings call as a public company. So I went through and I read that earnings transcript as part of the research for this video. And one of the things I thought that really jumped out to me the most from that earnings call was the fact that they have ambitions to break into the sports wagering space themselves. So when you think about online sports wagering right now, you're probably thinking about either DraftKings or FanDuel, some of those big names like that. But at the same time, it's like there are a couple of companies out there that kind of have like under the radar sports wagering exposure. And one of them happens to be Fubo. So Fubo said that they actually are already have it in the works to have their very own sportsbook. Now you think about that again, people are going to Fubo already to watch the live sports and watch them all in one place, especially again if they're not already going to be cable customers. So they're going with this streaming service on a connected TV, smartphone, laptop. They're going there to watch. But if they also have the ability to watch there and place a bet there, I definitely see that being a good combination, and I see that something that could be very successful for Fubo TV. And when we talk about that, by the way, because Fubo right now they're kind of trading about 5 times or approximately 5 times the projected 2020 sales. And when you look at that comparison to DraftKings is trading at about 30 times their 2020 sales. So there's certainly a much bigger premium that investors are placing on pure play sports wagering companies. But I do think that once this kind of gets out a little bit more, if they truly are able to execute on their sportsbook, I think that the multiple on the price to sales that investors are going to be willing to pay for Fubo TV will be even higher. Because right now, again, I mean, that 5 times versus the 30 times, maybe it's not going to be the full 30 times with DraftKings, but even if they were able to get up to an 8 times multiple, that would actually represent more upside for the stock than where it currently trades at. So also in this earnings call, management called out the fact that there are still 80 million people that have cable, in the United States, and so that represents a big growth market for, even now. There's been this big shift towards people moving away from cable, but certainly that there's a long runway for growth for Fubo. And then they also, made it clear that, so right now they are losing money, but when you look at it, having a subscription business, there's very much a long-term value to having a subscriber, right? So it's not just that if they have a subscriber that it's going to help them in one quarter of their business. They're able to, in a lot of cases, retain a lot of these subscribers and are able to monetize for years to come, kind of a thing. So when you look at that, the cost of the customer acquisition, you have to kind of smooth that out a little bit. So given the rate that they're growing at, given the fact that they're still a young company, and given the long-term value of their subscriber base, I think that it actually makes sense that they're actually, or we can, be a little bit more lenient with them losing money. And when we talk about that growth in subscribers, by the way, at the end of 2019, they had 288,000 subscribers. At the end of Q3 in 2020, they had 455,000 subscribers, and they're projected to finish 2020 with over 500 million subscribers. So again, they're showing really strong growth in their subscriber base. Part of that has been, again, with the shutdowns, some COVID-related things here, pulling some of that demand forward. But, the company's kind of called out that this was always kind of like the way they saw this trending anyway. It just kind of sped up the process, as it has for so many other companies out there in 2020. Finally, another thing I wanted to kind of call out from this earnings call that they had for the Q3 results here was an analyst talking about the results for another publicly traded company, the Trade Desk, rather. Talking about the Trade Desk and saying that they were seeing some of their customers that were switching to connected TV devices, that they were actually getting a better ROI on their advertising spend dollars. And that's another component to what Fubo does. So Fubo makes money from subscriptions, but they also make money from advertising. I think that's going to be a good selling point for Fubo in trying to get more of those ad dollars on their platform. Okay, so that's some of the recaps, some of the important parts, I think, from the earnings call. Now I want to walk through a model I put together. And so I'm modeling out revenue. We can talk a little bit about what their net loss has been so far on a year-to-date basis and what we can kind of project that to be for a full year, because again, they are losing money. But I primarily wanted to look at this and valuing it over the long term based on the price to sales, because with growth companies, I think it just makes more sense to take a price to sales perspective. And because if you know what a company is going to have in sales in 10 years, and you're able to kind of truly understand how much an investor is willing to pay for those sales, that's really all you need to be able to get to a valuation. That's just one methodology, but that's something I'm going to use here. So this company has a market cap of $1.4 billion. And I even want to take a second to talk about that, because when we talk about the market cap, I mean, if another company wanted to come in and buy a controlling stake in Fubo, it really wouldn't be that expensive to do. And so when you think about, again, like DraftKings, and you think about FanDuel, and you think about some of these other companies out there that are starting some of these sports wagering companies, especially if Fubo is actually announcing that they're going to be a competitor to them, it wouldn't shock me if Fubo is actually going to be acquired by a big gaming company, that is either already involved in sports wagering or kind of looking to get involved in that, because that's something that might be able to pair well with their own assets. So I would never recommend buying a stock solely because it might be acquired, because usually, by the way, when they're acquired at a premium. I would never recommend that as the sole basis for doing it. But I think when we get into this, I think we can actually find some other ways that we can unlock some value with Fubo, not just related to a potential acquisition. So to start, when we look at their share price, it closed on November 18th at $20.83. And this stock price has actually really been doing really, really quite well. And we look at it a month ago, I mean, this was something you could have purchased for $9 and change, and now it's going to take over $20. So in less than a month, this is something that's doubled. So it's really been on a crazy run. But again, as I kind of said, I think when we walk through this, I think we can actually still see there could be some value to this, even at the price point today. So again, with the 2083 closing on November 18th, market cap being at $1.4 billion, like we'd already talked about, they currently have 68 million shares outstanding. I just want to talk about this real quick. I know that with a lot of growth companies, especially when they're losing money like Fubo is, there's two main ways if you're going to continue to lose money but to sustain your growth. You can do that by issuing more debt, or you can do that by selling some of your own stock. And if you sell some of your own stock, you're going to dilute your existing shareholders, but a lot of times with these growth companies, they're willing to accept that trade-off to say, yes, we're being diluted, but you're growing so fast, we understand, it makes sense. So sometimes those things can still work out. But I'm going to look at the future valuation in 10 years with two different scenarios with their shares. I'm going to say, well, what if they just keep the same number of shares, which I think is pretty unlikely. And then the other one, I'm going to say, well, what if they actually increase in total their share count by 50% over 10 years, which is probably, again, the more likely case. And then you need to understand that share dilution, because ultimately, whatever you're projecting out into the future, what their revenue is going to be, you need to divide that by the number of shares that will exist at that point and not just today. Okay. So when we look at this, Fubo is actually projected in 2020 to have sales of over 241 million. and the company is expecting a growth rate of actually for 2021. They're expecting to grow their sales by 70%. So they're expecting to get over 400 million by the end of 2021. And again, given that rapid subscriber increase that we've already been seeing, I think that it's not that far-fetched to say that they actually could be growing by 70% into next year. But at the same time, on a year-to-date basis, we go ahead and take a look at this, and they have lost over $400 million. And it's been steadily increasing from quarter to quarter in 2020. So they lost just shy of 36 million, and then nearly 100 million, and then 274 million. And then, for me, I'm going to be projecting they're going to be losing about 300 million in Q4. So again, they're making $241 million in sales projected, but projected to lose nearly $750 million. So again, pretty steep losses there, and something you can never really ignore. I mean, like, you have to understand that, to some extent, companies that are growing fast and still losing money are speculative until they can actually prove that they can generate a net profit there. So my base case here, I'm going to start out by saying, okay, we know that their current price to sales, it's about 5 times. But let's even look at the projected price to sales. Let's say that in 2030 that they're going to be worth 4 times their sales, okay? And then let's also assume that they're able to get the 70% growth rate that the company was targeting for the next year. And then let's say that strong growth continues, they grow by 50% the year after that, and then they kind of level off and they have about 10% growth for years 3 through 10 to get us to 2030. Well, that would then see the company having $1.3 billion in revenue by 2030. And again, we can go ahead and take a look at that projected market cap, which is just going to be 4 times that revenue that we're assuming for our price to sales. And if we assume no dilution, so based on the current number of shares, that would leave them with a value of $77. But if we actually took the 50% dilution into account, that would leave them with a value of about $51 per share. And then we can also kind of take a look and say, okay, well, what annual return would that be? Well, based on the closing price on November 18th of that 2083, that would imply, even with dilution, an annualized return of 10.6%, which isn't really that much of a premium compared to what you would get from just getting an ETF that tracks the S&P 500. If you had that, you might be able to expect about 9 or 10%. So again, 10.6 doesn't really blow me away. But I think one of the things that, again, can unlock some of the value here is if they truly are able to execute on their sports book, and that is something that works out well for them over the long term. I don't think it's that hard to imagine that they easily could get to 6 times sales by 2030. Again, if there's still strong growth, they're making good ground into that market there. And you start looking at that and you can say, hey, even with dilution, with 6 times sales, maybe you can get yourself to close to a 16% annual return. And you could also say, well, what if they were to grow by 15% in years 3 through 10? Well, then all of a sudden, if they were trading at 6 times sales, had that elevated 3 through 10 years growth, you could start talking to yourself about getting a 20% return. But I personally prefer to take a more conservative approach when I'm looking at some of these things. So for me, I would want to leave this a little bit more conservative and say the price of sales at 4. I would want to leave the years 3 through 10 growth at 10%. And what we can do, because there's obviously a few different ways you can increase your annual return, and you can increase it by saying that the future value is going to be higher or the current value is going to be lower. So what if we waited for an opportunity to buy this stock at $16? Well, if you waited to buy it at $16, even with the more conservative assumptions here, you could start to talk yourself into or walk into a scenario where this would be giving you about a 14% annual return. So that's, I think, the way I'm actually going to play this. I really like the market that they're in. I think that we're going to see continued shift from people who are using cable to wanting to watch with a streaming service on a connected platform, something that gives them a little bit more flexibility to cancel, again, kind of paying just for what they want to watch and not kind of for everything. So I think we're going to continue to see that shift happening. That's going to help Fubo, and I'm also really interested to see if they actually are able to execute on their sportsbook, because again, I think that there's kind of some hidden assets there that could really help them out in the long term. So for me, again, I'm going to wait to see if this actually will pull back a little bit before I would buy it. And I also understand that that might never happen, okay? And I feel like, this might go from $20 to 30 to 40, and I just might completely have missed my entry point. But the good news is that there are literally thousands of stocks out there. So if I do miss it on this one, I can try to find it in the next one. So that being said, I would love to know what your thoughts are. Is this something you're currently investing in? Do you have an exit strategy for this? Love to know what your thoughts are. So let me know in the comments below. And I will see you next video.